You're listening to Capital Topics, episode number 61. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers at PWL Capital. In this episode, we'll discuss the following points with Raymond Kerzérho, PWL's senior researcher. First, we'll give you an update on PWL Capital's long-term expected returns on asset classes. And next, for a second topic, we discuss a groundbreaking paper from Scott Cederburg on life cycle asset allocation. Enjoy! Hello, James. How are you today?
I'm very good, François, and how are you?
I'm good, thank you. So as I've mentioned in my introduction, to help us tackle the two topics at hand for today, we have invited Raymond Kerzérho, PWL's senior researcher. So good morning to you, Ray. It's good to have you back on the podcast.
Great to be here.
Okay, Ray, in our first topic, we would like to review with you your latest update of the financial planning assumptions with your estimates of future asset class returns and volatility numbers. To clarify for our listeners, this report is updated twice a year, and the latest version of your report is now available on the PWL Capital website, and will also be available in the podcast link. So, Ray, let's jump right in. What's new in your report this year? I believe you made some changes to estimate inflation. Is that correct?
Yes, that's correct. Previously, part of our estimate for inflation was based on the pricing of real return bonds, Canadian real return bonds. However, the government of Canada has decided in November 2022, so quite more than a year ago, to stop issuing these bonds. Seeing that, we have delayed the decision, but eventually we made the decision in the latest financial planning assumption preparation to remove that from our estimate or method to estimate inflation. And as a result, we get an estimate that is slightly higher than it was a year ago. A year ago, we had an inflation estimate of for the upcoming 30 years of 2.2%. Now we're up to 2.5%. So that's basically the average of the target inflation rate by the Bank of Canada, and the so 2% for the Bank of Canada, right, and the long-term historical rate of inflation for Canada, which has been 3% exactly in the last 130 years. 120 years.
Okay, so you take an average of the two to get to 2.5. Yep. Okay, good. Thank you.
Ray, can you now update us on the latest numbers of the expected returns and inflation? And can you also highlight how these numbers differ from the numbers in last year's report?
Yeah, absolutely. So as I mentioned before, now our estimate for inflation is at 2.5%. And in addition to that, we provide expected return estimates for fixed income and global equity on a nominal basis. We've got a small reduction in expected return for the fixed income portfolio from 4.2% last year to 3.9% currently. Basically, the change is due to the decline in bond yields in the last year. For the all equity portfolio, we have a slight increase in the expected return from 6.9 to 7.1%. However, most of this increase is due to the fact that we have a higher inflation estimate. So that impacts directly our estimate for expected equity returns.
Why is that, Ray? Why does it impact directly?
That's a good question. As we know, we've discussed in other episodes of this podcast, when we look at, just to make the comparison with fixed income, when we look at fixed income, basically the gross yield to maturity is basically the best forecasting power for future returns. However, for the markets, we basically use the methodology where we start by estimating the expected real return on equity, and we add back the nominal, not the nominal, but the expected inflation for the coming 30 years. So we add those two components. So there's a direct impact when we change our inflation assumption. It adds back directly to the real expected return for equity.
Well, that's a really important answer to my question. Thank you, Ray, because we get often the reaction when we're doing financial planning projections. So, hey, look, our inflation estimate is 2.5, and we've come through, the recency bias of hey, inflation's a lot higher, and I think it's going to be much higher going forward. So people are sort of projecting out into the future with the recent experiences. So that's what our standard answer is that if we're going to adjust higher in your plan inflation rates, then really we're going to have to adjust the expected nominal or before inflation rates of return on the asset classes, be it bonds or equities.
Yeah. Those were the returns on bonds, the asset class of bonds and international equities. Now, what's the expected return for classic balanced 60% stocks and 40% bond? What's the expected return on that portfolio?
Yeah, actually, it's unchanged from last year at 5.8%. So you remember fixed income, we have a lower expected return versus last year, but for equity, we have a higher expected return. So if you mix those two for a 60-40 portfolio, now we have a slightly less than 6% expected return in nominal terms.
Yeah, okay, they compensate each other. Okay,
thanks.
So, Ray, the 60% stock, 40% bond portfolio, which everybody knows as the classic balanced portfolio, historically, it has generated over the long term about 85% of the return of a 100% stock portfolio. Now, there's some times, even recently, when rates got ultra low, when that was not the case, but especially prior to the global financial crisis in 2008. Now that we're in a period of more normalized, we call them, interest rates, if we look at your report and we take the expected return on 60-40 and we take the expected return on versus 100% stock, it comes pretty close to that 85% number. So what do you think of that, Ray?
Well, I think it's appropriate, and the historical data is confirmed by my calculation of expected returns.
Yeah. I should say, however, that the 85%, the 100% stock portfolio comes with a lot more volatility than the 60-40 portfolio.
Well,
yeah, and also I would like to add that the additional 1% or 1 plus a fraction of a percent you get with a higher equity allocation. Once you take account of compounding, it's a much bigger difference than it may appear at first sight.
So I don't know if we quoted for our listeners, but what is the expected return for 100% equity?
We've mentioned it at 7.1%.
7.1%. So
yeah.
So again, for that extra pickup in return, you're going to get a hell of a lot more volatility, and that's what the listener should remember. Okay, but that really leads us to our next topic, and recently there's been some academic papers published by a group out of the University of Arizona led by Professor Scott Cederburg. And this paper, the latest one, in a series of 3, is called Beyond the Status Quo, a critical assessment of life cycle investment advice. And we feel this paper is really, really important, its findings, and it should be shared with our listeners. In it, the major finding is that most investors, including both people in the accumulation phase of their investing career, so that's between 25 and age 65, and then people in retirement, should be 100% invested in stocks, but must be broadly diversified, including domestic and international stocks. So let's address that today, Ray, and we'd like your thoughts on what those research papers are all about, as they really challenge the common investment advice that, we've been applying for all of our career, which is that, risk and return are related. You need a part of your portfolio in the safe bucket and a part of it in the volatile. And it's a function of your risk tolerance, risk capacity, et cetera, that an advisor needs to coach you on, you being the client. So Ray, why don't you get into the topic of Professor Cederburg's research?
Yeah, before he goes there, I think it's a great topic for our listeners, and today want to discuss these findings with you, Ray. But it seems that the debate about the relevance of bonds has been revived, like James just mentioned. And a recent article in the Globe and Mail, which quotes our colleague Ben Felix, suggests again that most investors should be 100% invested in stocks. Is that correct?
I don't think so. I disagree with that statement. I think Ben and also Professor Cederburg have been much more nuanced in the way they talk about this topic. So I think it's really worth it to look more in detail in the work of these group of professors from Arizona State and other universities.
So let's get right into it, Ray. What are they saying?
Yes, so recently the big noise was about their most recent paper, but this same group of researchers have been actually publishing 3 papers in the last 2-3 years. And in my view, to understand really what they're saying and how it might influence the way an investor may choose to invest, it's important to take the broad frame of these, include these 3 articles in the broad frame of how we analyze all this. Basically, what they have done, so basically the start of all this story is really a database that I've started working with, and they've improved it. So it's a database of 39 developed country stock markets, including stock market returns, but not only that, also government bonds and short-term treasury bills. And also they document the inflation, rate of inflation for these 39 developed countries over 130 years. The important thing that they have done with that database is that they plugged a lot of holes in the data to reflect investor experience.
Yeah, so I don't want to dwell into the questions of methodology here, but of how they managed to create this new database. But can you give us an example so our listeners can understand better?
Yes, absolutely. An example of that is in 1914, when there was at the launch of the First World War. The U.S. market was closed for about 4 months and a half, from July to I think mid-December 1914. So they had a methodology to take account of that and make sure that the actual investor experience was certainly not perfectly, because there was a gray market at the time. People continued to exchange shares outside of the market.
Okay.
But they had a methodology to plug this type of holes and a bunch of others. There are plenty, of course, if you're considering a 39 country database over such a long period of time.
Right.
So really, how did they do that, Ray?
Well, for example, the case of 1914, they have simply what they do, they consider that instead of making assumptions about each monthly return, they consider the period from July, from the closing of the market to the reopening as one single period, and they use the pricing as a source of return. And that's basically the investor experience that would have been experienced for an investor who stayed in the market, actually.
That's clear.
But the other thing that's important in what they've done, because we have to be conscious on one thing: 130 years of data is not a lot by itself. Like a lot of the research that's published on long-term returns is based on returns starting in 1926. So in a couple of years from now is going to be 100 years of U.S. data. So it looks like a lot, 100 years, man, it's a lot, but not really, because if you look at long-term investing, there's not a lot of 30 years period into 100 years, right? There's not even 4 periods there. So by having 39 countries, you're expanding you're expanding your universe of and the number of long periods of investing. But also the other thing that they've done, they've put together a simulation technique to extract a maximum of information from the data. And that's really a key thing. What they call the block bootstrap is they can literally generate hundreds of thousands of scenarios out of this database. Although there's not that much data, they're able to extract a maximum of information from there.
Interesting. So thanks, Ray, for the technicalities here, but can you share the results with us?
Yes, absolutely. So getting back to our notion, we have 3 papers. I'll go very quickly on the first 2 because they're really important, although we won't do a deep dive on them. But the important thing, if you look at the first paper, basically it's they study they study risk, but instead of defining risk as volatility or drawdown, they define risk a different way. They define risk as the probability of losing money in the long run, and in this case, the long run is 30 years. So and the basic conclusion is there's a significant probability of losing money on a stock portfolio, and they estimate that to 12%. So even if you invest for 30 years, there's still a little more than 1 chance in 10 of losing money in the stock market on the one thing important here, on a real basis. So this is all adjusted for inflation. You can make money on a nominal basis, but if you lose after inflation, it's not really interesting. So basically, there's really a fairly significant, according to this database and their methodology research, there's a more than 1 in 10 chance of losing money in the stock market, even over 30 years.
And that, Ray, for, most of our listeners are probably saying to themselves, like, wait a minute, we buy the concept of stocks are for the long term and ignore the noise of the current market volatility. So, they understand there's risks investing in the stock market, but to tell most of these people that, over a long period, and it's nice to know they define long run as 30 years, because most people would agree 30 years is a long time, but they think the market goes up. Now, that said, as we're recording this, the Japanese market has just broken through the high that they reached 31 years ago. So if you're a domestic market only investor in Japan, you have gone 31 years without equities going up. So what are the academics actually saying here?
Well, what they're saying is that the stock market returns are not guaranteed even over the long run. And I think it contradicts the first statement that we were discussing, that everybody should be 100% invested in stocks. So if you look at the first paper, it says exactly the opposite. It says, wait a minute, you should be prudent with stocks. And there was a thesis that's been out there for several decades now that stocks in the long run, you're going to endure volatility. But if you stick with stocks for the long run, you're guaranteed to almost guaranteed to make money with your portfolio.
This kind of contradicts the thesis put forward by Professor Jeremy Siegel in his famous bestseller, Stocks for the Long Run, doesn't it?
Exactly. I think it tests the hypothesis of Professor Siegel. And I remember reading a long time ago his book, Stocks for the Long Run. I thought that the problem with this statement is that it was mostly based on the US data. And it's definitely a problem because the U.S. market has been the big winner of the last 100 years plus. But we cannot project that in the future. There's no guarantee that is going to happen the same thing is going to continue in the future.
But wait a minute, Ray. It's pretty simple, and we talked about this in our podcast last year when we did the annual yearbook for the Credit Suisse Research Institute. if you're an American and you start looking at investing internationally, you'd sort of scratch your head, and why should I do that? And so American exceptionalism has gone through extensive periods, the 80s and 90s, and now in the last 12 years since the global financial crisis, you'd be really tempted just to say, the hell with the rest, I'll just invest in U.S. stocks.
That's understandable, but if you look at the scientific evidence, and if you look at the opinions of financial economists in general, I would say that there's no scientific evidence to support the idea that the U.S. must continue to outperform going forward.
And we can't be sure that the U.S. market won't become the Japanese market. We saw a lost decade after the tech bubble burst, but not a lost 30 years. In any event, it's really food for thought. So let's go from there.
Yeah, so that was based on the first research paper. What does the second research paper say, Ray?
The second paper expands on the first one, obviously. And they say now that if risk is defined as the probability of losing money in the long run, like we've said for the first paper, fixed income is riskier actually than stocks. So that's the interesting part. Yeah, absolutely. Yeah. So what they're saying is the least volatile asset classes are the riskier from the perspective of losing money in the long term. And I'll give you some details here. So here's the probability of losing money over 30 years with short-term T-bills. And I must remind our listeners, we're not only talking about US T-bills, but T-bills from any of the 39 countries in the study. Developed countries.
And it's real return again.
Real returns, absolutely. So the probability of losing with short-term treasury bills is 37%. So more than one chance in three. So it sends a message. Actually, lots of people in the last few months were saying, well, I can get 5% in a high interest savings account.
Correct.
But short-term interest rates change very, very fast. We could be at 0% in a couple of years from now. So that's one thing. Let's get back to our topic. 37% for T-bills. This is the riskier asset class that they've studied. The other asset class they've studied is government bonds, intermediate term government bonds. The probability of losing money is 27%. So more than one chance in four. For domestic stock, domestic, for example, a Canadian investor investing in Canadian stocks, or an investor in any of the 39 countries investing in his own stock market, the probability of losing money drops to 13%. So this is a huge drop. Now, there's a last thing that's even more interesting. So that's another conclusion that for sure your listeners have heard a number of times. If you invest into an international stock portfolio, then the probability of losing money drops to 4%.
Yeah. Well, as Canadians, where we sit right next to the U.S., and we know that over-investing in our domestic market can for very long periods give very underwhelming returns when we compare ourselves to our neighbors to the south and their market. So we've been pretty internationally diversified, as we've explained on our podcast. We've had 20% Canadian equity in our model and 80%, most of which is U.S., and then international, developed and emerging markets. But so what they're really saying is that's the way to go, and you should not stick to your own domestic market. And that reduces the risk of losing money by 2/3 over the long term. And again, losing money is also included losing it relative to purchasing power, which is really the key that our listeners should be focusing on. It's just this notion of real returns are what matter.
Absolutely. And I would like to add one thing also, is that by moving or by making a portfolio more of equity, more international, you're reducing very significantly the risk, but you're not sacrificing expected return, not at all. It's the same expected return.
Wow. With the traditional investment advice, good quality bonds are considered the safe assets. But Professor Cederburg's research, however, concludes that bonds are only safe over the short term, but over the long term, inflation kills the real return of bonds. In effect, he's saying that treasury bills and government bonds are much riskier over the long term.
Yeah. And also,
that's correct.
Yes, but we have to keep in mind we're talking to a financial economist. So for a financial economist, even 10 years is short term, right?
Yeah. Okay.
So you remember, gentlemen, with me, we were working together in the first decade of this century. We had very poor equity returns over 10 years, with two successive bear market in stock, very severe bear markets. One with the tech, the dot-com bubble bursting in the early 2000s, and the market had barely recovered from that it crashed again in 2008, 2009. So at the end of the decade, there was barely any return on stocks, and bonds were really your savior. So yes, it's long term, but 30 years is a long time to wait for your return. So I don't think Professor Cederburg is saying that volatility risk should be ignored. What he's saying is that there's really a balancing act or a trade-off you should make between having your long-term return or minimizing your long-term risk and minimizing or optimizing your volatility risk. It's really a trade-off there.
So let's discuss the third research paper, which is the one which prompted us to address the topic. What does it say, Ray?
Yes, let's go with it. Basically, these group of researchers, they propose another definition of risk that is really an extension of what we've seen before. They define risk as the probability of running out of money in a lifetime. So we're really putting ourselves into the shoes of an investor. So what they've done, once again, they use the same database, 37 developed countries, stock, bond, bills, asset classes, inflation is incorporated there. What they do, they simulate 1 million couples across 39 countries, or 1 million couple lives across 39 countries. All these couples save 10% of their income from age 25 to 65. So they assume they have a career of starting at age 25 and last 40 years. And all these couples withdraw 4%, inflation adjusted, after age 65 until they pass away. And the other thing that's interesting, so it's not only a simulation about stock returns and treasury bonds and T-bills. It's also a simulation that incorporates both mortality and job security risk are modeled in the simulation. So that's really they really expand this thing to answer the question: what gives me the best chance of not outliving my money, actually.
Interesting.
So to move on, basically they compare 5 strategies. So first, it's a strategy of investing all your money 100% in the treasury bills. The second strategy is a 60-40 portfolio, so 60% stocks, 40% bonds. The third strategy is the strategy of 120 minus age. So what you do when you're young, let's say your age, they start at 25. So but at the start of the simulation, our investors are 95% invested in stocks and 5% in bonds. And each year they reduce their stock allocation by the increase in their age. So at age 26, it's down to 94%, so on and so forth. So that's the third strategy. The fourth strategy is 100% domestic stocks. So if it's a Canadian couple, there would be 100% invested in Canadian stocks, for example. The fifth strategy is 50% domestic stocks and 50% international stocks. So that's really a basic strategy that simulates a couple that adopt international diversification with a home bias in the portfolio. So that's really the 5 strategy they compare. But to make a comparison, you need to have performance criteria. So our authors, they propose 5 performance criteria. The first is wealth at retirement. So how much wealth you have at the time you reach past age 65. The second one is wealth at the death of the second spouse. Keep in mind, we're making simulations for couples. So really what matters is to finance the retirement for the two couple members. The third performance criteria is retirement income replacement. So basically, the more money you accumulate at the time of retirement, the more you can withdraw from your portfolio, especially we assume it's a 4%. So 4% of a bigger portfolio means more higher retirement income.
Yep.
The fourth criteria is drawdown. So the risk of having a short or even prolonged decline in the portfolio wealth.
Okay.
And the fifth criteria is the risk of outliving one's money. So that's really the one that is innovative here. So to give you the results.
But it's innovative, Ray, but it's also, top of mind for virtually all investors and our clients, which is, I don't want to run out of money. So the longevity risk is really, really, really important. It's really neat they tackle that.
Yeah, absolutely.
That all makes a lot of sense to me. So what are the results, Ray?
Exactly. So pretty quite straightforward. So some of these, the first results I'm going to give you are not surprising at all. So for wealth at retirement, wealth at the death of the second spouse, or call it bequest, and retirement income replacement, the internationally diversified stock portfolio dominates all other options, be it a balanced portfolio, T-bills, what have you. It dominates completely. It creates more wealth, creates more retirement income. That's pretty straightforward. Anybody would have guessed that, right? The fourth result is not surprising either. The all equity portfolio, be it the all domestic or all international, they both create a fairly large drawdown compared to either T-bills or balanced versions of a balanced portfolio, 120 minus age, or say 60-40. So it's much more risky to have an all stock portfolio from a drawdown perspective.
Okay, Ray, but again, these findings, they make sense to me. Really, what's innovative here is that they're telling you that most of the academic financial economics are using 1 month, return data series, and they're saying no, you got to use much longer data series, and that piggybacks, by the way, to our most recent podcast where we spoke about the book, The Price of Time by Edward Chancellor, where he's looking through the millennial on how interest rates have evolved and how that's impacted, economic activity. So again, not too many big surprises. Portfolios fully invested in stocks, including international stocks, will generate higher returns over the long term. But it's not a free lunch. Risk and return are related, and is therefore normal to expect more return for taking more risk.
Absolutely, but at this stage, we're discussing basically the volatility risk, because drawdown is basically an expression of extreme volatility, right? Or negative volatility, as you call it often. But now the new result that is, I think, a lot more interesting, and frankly, I was a little bit surprised about it, is that the internationally diversified stock portfolio minimizes the risk of outliving one's money. It surpasses all other portfolios in this term. And that's really the surprising result. And that's why some commentators have extrapolated from that they recommend investing 100% in stocks. But once again, they don't say that. They're not denying that volatility risk exists. Volatility risk is there. But if you want to optimize or maximize your chances, according to this study, the internationally diversified portfolio is far better than all of the other scenarios, including domestic stocks, obviously.
Yeah, the probability of outliving one's money is really the big issue for most of our clients.
Absolutely, François. Longevity risk is the big issue, and we're seeing that in the client base with clients we've had for over 25 years, where they've gone through the life cycle of mid 50s to age 75, And now really they're looking at age 95. So, in Scott Cederburg's research here, they're talking of saving from age 25 to 65, which is 40 years. And then you've got another 30 years after that. So there's these ultra long time horizons. So again, the other thing that we found recently, and actuary Fred Vitesse wrote about this in the Globe and Mail last year, where he had these interactive charts and highlighting the longevity risk, but actually that people that are well off, their life expectancies are actually much longer because they have less stress, their health, their diet, they're just basically, because they're financially more secure, they live longer. So than the average population. So again, these are very important facts.
So maybe we should move on. So I would just like to reemphasize once again, this study has been done. They've been saying basically we push on the side all the emotional side of investing and the stress that it is to endure a prolonged, even a short period or a prolonged period of wealth decline or financial wealth decline. So they're putting this aside, but they're not saying it's not important. They're just saying, here's the result we get once we take away this thing, and here this is what we have. So I think that's a big assumption. They basically in their study assume that our investor is absolutely rational. So that's really where investors are like robots, and they don't care almost of seeing their wealth decline.
Yeah. So if I understand correctly, a couple who invest throughout their lifetime in 100% well-diversified portfolio of stocks has less risk of running out of money than if they invested in a balanced portfolio. So that's the case whether they maintain a proportion of 60% stocks and 40% bonds throughout their lifetime, or start with 100% stocks and gradually reduce stocks in favor of bond as they age.
Yeah, absolutely. One other thing that's important to mention is also that they assume that markets are going to behave in the future exactly or similarly to what they behave like in the database. And that's not guaranteed. It's a very good database. It's a very good methodology, but we shouldn't take for granted that it's 100% sure that it's going to be it can be projected in the future.
Ray, what I also find interesting in their findings is that you can look at it from the other angle, which is what amount of savings that's required. And so what they're saying here is that based on 100% equity, 50% domestic market, 50% international, unhedged, that by investing that way, you're saving 10%, you get to a goal at age 65. But if you are, more risk averse, as most people are, and you have a stock and bond portfolio, and you decrease your stock allocation as you increase with age, and they use the sample of what they call a target date fund, which in the U.S. by regulation has specific rules of how you reallocate more money to bonds as the investor ages. They came out with you're going to need to save 41% more, or 14.1%. So there's no free lunch again if you're not willing to accept that risk of very high drawdown in certain periods, and it may stay that way for a long period, then you're going to just have to save more. And so that's just basic logic, right?
Exactly. Like everything in economics, it's a trade-off. There's rarely any free lunch. You have to make a decision.
Yeah. So if you're more risk averse, you'll need to save more to get the same standard of living when you retire. Ray, can you now explain why the 100% internationally diversified equity portfolio is so dominant?
Yes, absolutely. That's another very interesting part here, because it's all nice to observe the results they get, but the most important thing is the why. And there's really four reasons they identify. First, the most obvious one is the stock 100% stock portfolio has a higher expected return. So I think on an interview, Scott Cederburg has mentioned that by his estimate, stocks have about 4 times the expected return of bonds on a real basis, so net of inflation.
Yeah.
In my opinion, it's more like 3 times, but we can negotiate that.
3.5.
So that's one thing, higher expected return, pretty straightforward. But the other thing that's important, they mentioned that, but it's also, remember in the Jeremy Siegel book as well. I was reading it during the holiday season, and he mentions it, is that stocks have one other thing in their favor, is that they have mean reversion working in their favor, which means when stocks go through a very good period for a prolonged period of time, it tends to revert to the mean. So it means it tends to underperform following a long period of outperformance, but also following a period of underperformance, it tends to revert to the mean. It tends to outperform, to rebalance, if you will, its return over the long run. And bonds are not like that, are not quite like that. Historically, bonds, when they start underperforming, they may underperform for a very long period of time. So that's the big thing that works in favor of stocks. It's not only the higher expected return, but the mean reversion behavior that has been preserved in the simulation technique that they've used, basically is another point in favor of an international stock portfolio. I got 2 more. The other thing is that by making a stock portfolio internationally diversified, such a portfolio provides protection from domestic inflation. So it may happen, for example, that for some unknown reason, let's say the lack of housing in Canada, there's a big binge of inflation that is not observed in other markets. While having investments in international stocks helps the investor being protected against that in the long run. And the fourth one that is also very interesting, I think, because over the last, I'd say 20, 30 years, a lot of investors, including professional investors, have been assuming that bonds perform positively when stocks go down. But it's not always the case. And also this research provides evidence that, to the contrary, in the long run, I'm not talking about 3 to 4 to 5 years or even months. In the long run, the correlation between stocks and bonds is much higher than it is in the short run. Correlation may be as high as 0.5. So basically, in the long run, bonds don't provide much of a protection against poor stock returns.
So Ray, let's wrap it up. What should our listeners take away from all this research?
Well, really, my big takeaways, first of all, we have a fairly strong confirmation that an internationally diversified portfolios dominate a home-based portfolio. It's less risky and it provides a similar expected return, if not the same expected return. And my other conclusion, basically, is that the job of advisors financial advisors is to keep clients invested in stocks in the long run, even for retirees, maybe except for retirees who have a lot more wealth than they need to fund their retirement. For most retirees, it's the job of advisors to keep clients invested in the market at all times for at least a significant portion of their assets.
Yeah. For a Canadian investor, is there a better mix of international and domestic equities, or?
Well, the authors have studied that. So they started from a 50% domestic stock allocation, but they have also made simulation with lower domestic stock allocation, and they came to an quote optimal, or the lowest risk of outliving your money, with a 35% allocation to domestic stocks. There's been an exception for U.S. investors. An all U.S. stock portfolio would have done the same as an internationally diversified portfolio. But for other countries, It's basically 30-ish, 35%. But I have to mention, though, that be it 35 or 50% in domestic stocks, it made a small change in the risk of outliving the money, but not huge.
So, Ray, according to the research, a mix for a Canadian investor would be 35% Canadian stocks and 65% foreign stocks.
Yes, but always remember that these conclusions are based on a list of assumptions, one of which we assume that investors will behave rationally over time.
Yeah, and Professor Cederburg, when he was on the Rational Reminder podcast with our colleagues Ben Felix and Cameron Passmore, number 284 of the series, basically acknowledged that this is a big if. So as a portfolio and financial planner with over 25 years experience, what this research tells me is that clients really need to continue to create wealth even during retirement. And we've seen that because, again, if you're retiring, especially if it's early and you got a 95 or 100 life expectancy assumption, then that's a long period that your assets have to provide inflation adjusted financial resources. So you should have a higher percentage in equities, internationally diversified, again, to protect against this longevity risk and inflation. But really, that inflation is what really grinds away over the very long term. And so, again, I'll say the combination of the longevity risk and the inflation risk really support the findings of this research. So finally, I would say that one of the assumptions that investors will behave rationally, again, is the fundamental challenge. You think back at the global financial crisis, we were meeting clients, senior executives of major corporations who were losing faith in the capitalist system, in this central banks. So that's really important, that you assume that you can always stay the course. And we know from experience that most investors, if they're not backed up by a financial advisor who's able to help them with behavioral coaching, they're more than likely to underperform the markets because of their behavior.
Mm-hmm.
Yeah, absolutely. I agree, James. I think having a portfolio invested with a fair share of stocks actually is a big stress for most investors, and they need to have some support to handle that challenge.
Yeah. Well, I think this wraps it up. Thank you, Ray. It was a very interesting discussion. We hope to have you back soon on our podcast.
My pleasure, François.
And thank you to you, James, for sharing your expertise and your knowledge.
My pleasure, François.
So that's it for episode number 61 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on April 11th. In the meantime, make sure to consult our Capital Topics website for latest blog posts. See you soon.